What is going on? Welcome back. I hope everybody is having a great week. Welcome to my channel. I am the Covered Call Guy, and for those who are new, my goal here is to create $120,000 in annual passive income. Currently, I have 7 holdings with GPIX, QDIVO, GPIQ, IWMI, SPY, QQI, and IDIVO, and it is currently giving me about 70 grand a year, which translates to about 5.8k a month, 1.3k a week, $193 per day, and $8.05 per hour. Legal disclaimer before we start this video, though. Okay, this is purely for entertainment and education, okay, not investment, financial, or tax advice, because I am not licensed, certified, qualified, or caffeinated enough to do that for you. Okay, all opinions expressed are my own. They may be wrong, misguided, again, straight up nonsense. Okay, please do your own homework, your own due diligence, and talk to a real professional before making any money move. Remember, I am just some random stranger on YouTube, and I could be spectacularly wrong. Okay, like this video. Okay, for those who are new, this is going to be a part 2. For those who are not new, I've done a video on this with Tuttle capital management. So I'm going to be talking about the income blast trap and why I think the insane advertised yield from decay quoting 40% or MSTK at 50%, right? If it sounds too good to be true, it probably is, at least in my opinion, right? We're going to be breaking down the hard reality of these zero-date strategies, because I know a lot of you guys love it, and I think we should just do a review. It's been 4 months into 2026, so let's see, what's new with these ETFs that they have. Okay, all right. The yield illusion. Okay, according to their own fund disclosures, up to 80% of the distribution from funds like decay and MSTK have historically been classified as return of capital. Now, you gotta dissect it yourself. Is that constructive or destructive? Okay, so in the way, if you ever understand how it's bad or good, then it would be literally handing your own money back to you. Okay, physically shrinking your capital base. Now, that would be destructive, right? And aggressively marking it as income, right? So prior to its liquidation, MSTK's 52.5% dividend yield was actively masking a brutal negative 61.6 year-to-date NAV collapse. Okay, so this is a fact. Your cost basis hit zero from rock distribution, so all subsequent distribution becomes taxable capital gains. All right, this is a slow motion liquidation. Okay, this is why my first part of the video, I wasn't too fond of it. I was going to give it some more time, but I didn't end up buying any ETFs from this issuer. Okay, the MSTK disaster. For those who own it, why? I don't know. Why did you pick this one? Leave it in the comments below, right? So let's take a closer look at the facts of MSTK, right? So it did promise to capture MicroStrategy extreme volatility using daily cover calls, okay, showing an optic of 52.5% yield. But the reality is that as of year to date, it has collapsed 61.60% this year before the board of trustees finally approved its liquidation. Okay, it is gone. Okay, by selling daily calls, they capped the explosive upside days mathematically and required to offset the frequent violent downside days. I have always mentioned these type of these are permanent trade-offs, right? The premium collected was structurally insufficient to cover any of the volatility drag, right? Applying zero date time expiration to highly directional assets destroys capital. Okay, the meme in the crypto meat grinder. Okay, so for the most part, a lot of these are going to be the meat grinder, right? Probably out of 95% of it is going to be meat grinder. You're going to have to find the nice 5% that actually works. Okay, if you look at the performance data, it gets worse, right? Mimi, which is the meme stock, right, crashed 25% in just 3 months, and BitK, which does the Bitcoin, plummeted 30% year to date, right? So these funds uses a zero-date time expiration cost to harvest extreme implied volatility. But when the underlying asset spikes intraday, your profits are strictly capped by the short call, okay? So conversely, when the assets drop, the fund absorbs the full downside, right? So that I always express this a lot, and I talk about this a lot. You have to worry about this. This is where, if you're going to capture the full downside, make sure it captures most of the upside, okay? This is a fact. Extreme implied volatility in retail sectors is an indicator of genuine structural risk, not a source of easily harvested yield. Please understand that when you're doing your own due diligence, you have to understand the structural strategy behind these cover call ETFs. That's why I always stress, hey, be careful when you're doing these speculative assets. On then top of that, you have a strategy that caps you. All right, hidden fees and the death zone. Let's look at the 0.99% base management fee. Right now, you are paying to lose, okay? You are paying a massive 0.99% fee for funds operating in what I call the death zone with microscopic assets, right? Triggering brutal bid-ask spreads like SPCI's 2.23%. I stress this so much. You can even know in a comment. There's probably someone that's been watching my channel since I have less than 100 subscribers making these videos. I always stressed the expense ratio, right? I know someone's gonna mention. I just forgot to. I know there's a guy that leaves a comment and sometimes leave a comment on other comments saying, I always don't pick a fund because sometimes of the expense ratio. Damn it, I know who you are though. He's one of the OGs. You know who you are. You're one of the OGs. But this is why I stress, hey, you have to be aware of the expense ratio, right? You may not think it's high. Oh, 0.68, oh, 0.80, oh, 0.56. It is pretty high and it's quite high. If they are not performing, you are literally losing money every month, getting taxed. It's a loss. And this is why I stress this, guys. You have to worry and you have to look at the expense ratio. They have to make it worth the money you're paying them. Okay, so this is another stress that I always put on the previous videos, is the assets under management. If it's below 50 million, it means the fund survival is a mathematical threat. I want to look at assets under management over 100 million. Why? Because for the most part, after they cross that $100 million mark, they start entering what we call like the medium size, right? Not the big boys yet, but the medium size. And they have more money for the bid-ask spreads. They get more favorable, pennies on a dollar, right? That's good. The cheaper they get it, the easier, the profits for the profits margin, right? That way they're able to make more profits to, earn that paycheck we're giving them, okay? And if you look at MSTK, which collapsed at a tiny 277K assets under management. Why did anybody buy this? I don't know. I mean, am I vindicated here? Because if you look back all my videos, I've been saying this, guys. As good as it sounds, you do have to worry about expense ratio, assets under management, right? A lot of this matters. I've been doing this for almost a decade, so I feel like I know what I'm talking about. But so as of April 2nd, 2026, the fund is scheduled to liquidate and close with its last day of regular trading on the Cboe BZX exchange set for April 14th, 2026, and then it's goodbye. Okay, so what are they actually doing? Well, they aren't even buying the underlying stock, right? Data, which I love using data because I'm pointing out, especially historical data, they have it. The data proves they generate your yield entirely through a fragile web of synthetic mechanics. And for those who are the OGs, I stress this enough. Synthetic. Just think of Fugazi, right? There's more risk to that, right? So it's synthetic collateral. So between 93% and 117% of the net asset value is parked in US T-bills. If the T-bill, look, with these rates, if they're not going up, it's even harder to generate the yield, right? It'd be nice if the rate was 5, 6, 7%. That makes them easier, right? So they use this cash as a collateral for the most part. They have to when they're doing synthetics and or hedges, right? To synthetically recreate equity exposure. So it's just a collateral, right? It's like putting your mortgaging your house or financing your house to get money out of this. All right, so flex options, right? So flex options, for the most part, the easiest way to understand this is not going to be for us retail investors. Most of these are from hedge fund to hedge fund, bank to bank, pretty much medium-sized financial companies kind of trading with each other, doing agreements, ELNs and stuff like that. So flex options is not going to really be for us. So just understand, flex options is more for like the big boys on Wall Street. 0-day resets, right? So by rolling 0-day time expiration options, they try to avoid overnight gap risk, but this is a hyperactive turnover which generate massive transaction costs that silently drag NAV. That's another thing, right? So a lot of people are asking, why don't you get 0-day time expiration cover calls? Well, for the most part, I do have it on watch list, but I'm not a big fan of it right now. As much as they capture the highs, again, they will capture the lows. Right now, I'm just gonna stick with my investing philosophy of sticking with monthlies. Sometimes slower is better, right? You gotta pick, right? Are you the turtle or are you the hare? Right now, I'd rather just be the turtle, slow and steady, right? We're gonna cross the finish line. Sometimes you might cross it faster than I am, but taking a bit more risk. I'll be right behind you guys. All right, the Greeks. I'm gonna try to explain this simply for those who are new. All right, I'm gonna try to explain the Greeks so anyone can understand why this 0-day time expiration strategy is incredibly toxic for long-term investors. And if you're not a long-term investor, support the channel, but I don't know why you're here. I consider myself a long-term investor. I don't buy things just to sell it within the next week or month, right? I plan to hold it for the next 30, 40, 50 years. All right, so data, think of this as the bait, right? Data is time decay. So options you lose value fastest in their final hours of life, right? So by the 0-day options, all right, Tuttle is engineering these ETFs to act as the ultimate data harvester, right? Scooping up massive premiums daily. As soon as they scoop it up, they have to get rid of it, right? Gamma, which is the killer, right? So to get that data, they expose you to extreme gamma, right? So gamma means even a microscopic intraday price swing causes extreme, violent, exponential losses for the option seller. Okay, so a sudden trend turns a profitable call into a massive loss within minutes. Yes, minutes. Okay, it can literally one post from the president and goodbye. Right, so the Mago put spread trap. Now, for those who are new, I originally have Maggie, and I was gonna either choose Maggie or Mago, or do a split between the two. Eventually, I let Maggie go. I have a video on that. Just watch it, please. You support your channel, watch it. All right. I'm probably not going to go back into Maggie or Mago. I just don't think it's a good fit for me and doesn't fit my investing philosophy. All right. So instead of cover calls, right, Mago uses what we call a put credit spread on the Mag 7. So if tech drops, you absorb the maximum defined losses of the spread week after week, right? So the data did confirm this. It's down about 13-14% year to date. Round it off, just say 15% if you want to just give yourself that buffer, right? So what does it actually hold? It has UST bills, which is 96% of the portfolio weighting. The strategic impact of this is, again, cash collateral tied up in fixed income, okay? And then the rest is pretty much in Tesla for the short put, and Amazon, Microsoft, Nvidia short puts, right? So for this, the strategic impact is you absorb the hit if Tesla drops below the strike, and zero protection against tech sector contraction. So how does Mago perform? Well, Mago is really for... I would say you should hold it long term if that's, ideally. Mago does well in extreme bull market. So again, not something I would hold anymore. I think I'm just gonna let these go. I believe it is a weekly payer. I could be wrong. I believe it is. I think it has a 25% yield. I could be wrong. I think it has a 0.99% expense ratio, which is kind of ridiculous. Not a big fan of that. That's one of the main reasons too. Again, I do factor these in. Some of you guys can say, "Oh, you're so picky with this," but I just am with these stuff. All right, the macro trap. Right. So right now we are kind of being stuck in a stagflationary trap. In 2026, right? Inflation is right now recalcitrant at 3%, 3 to 4%, right? The Federal Reserve has paused rates, so it's anchoring us around any 3.5 to 3.75, should say 3 to 4%, right? But why does this matter to you and I, right? Elevated interest rate directly increase the cost of carry, okay? So this is a macro environment that inflate call options but crushes the pricing on put options that Tuttle is trying to sell. Alright, so this is just another headwind actively destroying the math behind the put spread strategy. Alright, study crowding. This is a massive structural threat here. What I mean by that is the alpha decay from institutional crowding. Traders are now executing over 1.5 million zero-day time expiration contract daily, right? 60% of total index value. So this does matter if you can look at 2022 2026 now, because everyone is systematically selling the exact same short call flow, right? Premiums are pretty much getting crushed here. So to keep promising high yields, issuer has to take on riskier directional bets to survive. Again, as it gets more crowded, money flow is just going to go into the ones that are just been here a while, the well-known names that has the bigger assets under management, and hence why I stick with those. All right, the only bright spot is SPCI. Perhaps this is like one of the most kind of, a lot of people are expecting it to be a success, right? I'm gonna try to be entirely fair to the data, right? So let's just look at one area that has worked so far, which is SPCI. That's their quote-unquote space industry ETF. Right? It's actually up about 7% since March 2026 launch. Again, it's about 5 seconds old, so take it with a grain of salt. It's probably betting on Elon's IPO with the SpaceX. Okay, why did this work while others failed? Well, again, because aerospace and the defense sector has immense government tailwinds right now. And again, it is about 5 seconds old. It just literally launched, right? So in a strong, sustained sector rally, put spread strategies get to keep all of the premium because the short put expires worthless. That's the best and easiest way I can explain it. You do have to beware, okay? You are trading one risk for another, okay? You now face extreme sector concentration risk into a highly capital intensive industry. This industry is a money burner. Not a money pit, but a money burner. Hey, let's look at the reality check of peer comparison, okay? So looking at institutional facts here, these are the data. We benchmark Tuttle against direct tactical peers like YieldMax and the big boys, okay? I like to compare it to the big boys of JP Morgan. The numbers do not lie here, okay? Right now, my guess for YieldMax MSTY is that it mirrors the catastrophic collapse of Tuttle's MSTK. Could be wrong here. All right, so this is proving that zero-day time expiration MSTR strategy is fundamentally flawed. I do think so. That's one I'm gonna die by this. I really do think though. MSTY only survived liquidation because of its massive $1 billion liquidity buffer. That's the only reason why I think it's still around. Other than that, it's really pretty much the assets under management keeping it alive. Right. So if you look at this, the peer-to-peer winner, the top tier winner is going to be JEPI. Right. Outright dominates, rock bottom fees, unmatched liquidity, and actual capital preservation and actual profits. Okay. I don't know how to stress this enough. If you're going to pick something, if you're thinking of Tuttle, might as well just go to JEPI at this point. Yeah, I think it's the better choice. All right. So when does this actually work? I've been being a doomer this whole video, but when does it actually work? So we backtest these volatility regime using historical simulation. Okay, this is scenario based, and these results are undeniable. I think this is going to be true for the most part, even if it's scenario. Bear market, death, it's gone, right? Traditional cover call shields has minor downside. Zero-day time expiration resets daily. So meaning, again, when you eat the gains and you go higher and higher, when it's a bear market, you're gonna eat the full downside of a crash, right? You miss the violent relief rallies because your upside is permanently capped. In a bull market, you're missing out. Looking at 2023 to 2024, the tech bull run, right? JetQ captured the tech upside about roughly 36%. Zero-day strategy systematically sell away the tail of the rally every single morning, so vastly underperforming. And the sideways chop, of course, I think this is where obviously you guys have to, this is the only time I think you guys would win here. If the chart goes nowhere but chop violently due to earning misses and Fed noise, this is where you would win here, right? Harvesting elevated intraday data while the index drifts sideways is the only profitable environment here. So you're losing 2 out of 3 here. Is it really worth it? That's where you're gonna have to go, okay, does it fit my investment thesis? Right, my final verdict here, this is my ultimate part 2 actionable portfolio matrix, right? This is just based on the institutional data that we have seen, right? Because you need to respect what these two are actually built for. Core and retirement, absolutely not. Again, I'm gonna stick by it. No, right? That there's factual NAV erosion, high fees, and the total lack of principal preservation will ruin you, right? It's mathematically violates basic retirement mandates. Yield enhancement, extreme caution here, guys. Again, they're offering you the 40, 50, 60% yield. Of course, this is the yield booster, right? You should and only can only allocate less than 2, maybe 5% of your portfolio here due to severe liquidation risk. Again, not something I would pick. This is one of the reasons I stayed away from it, right? Extremely wide bid-ask spreads and high beta. Volatility trade, sure, if you are seasonal and experienced enough, right? This is the primary functional use of this issuer's ETF, in my opinion. You can only and should only buy these if you are a sophisticated trader making a highly specific short-term bet to short intraday volatility. Other than that, guys, stay away from this. Not worth the headache. Okay, hope you guys got something out of this. Hope this was informational. Hope this didn't, bore you too much. I just wanted to make a part 2. Again, I do like to follow up. I'm probably gonna do a part 2 on State Street ETFs again. I love these specific, these sector specific cover call ETFs. I will be doing another follow up on how possibly they grown or did not grow, but. In terms of Tuttle, let me know if you guys own anything from Tuttle and how it's been treating you. If you're adding to it, or you're holding, or you're possibly trying to sell out of it now, I may be interested. I don't think I would be buying this anytime, not anytime soon. So let me know. Drop your thoughts on Tuttle ETF in the comments below. I read all comments and try my best to reply. So thanks for watching, guys. Stay tuned. Catch you guys on the next.